Now we go ahead to unlocking the India business opportunity. Understanding these opportunities is critical for business and investors looking to engage with one of the world's fastest growing economics. Please join Mr. Ashok Wadhwa and Mr. Puneet Renjhen, chaired by Professor Marvin Fernandes and Ms. Soniya Gupta-Rawal, as they discuss strategies and insights for unlocking the vast business opportunities in India.
Thank you so much, everyone. So we have Mr. Ashok Wadhwa, who's the founder and serving as the Chief Executive Officer and board member at Ambit. Prior to founding Ambit, he was the managing partner of Arthur Andersen in India. He has received several awards, commendations, in recognition of the excellence in field of finance, including Priyadarshini Academy Award for outstanding contribution in the field of financial management. Thank you for coming here, Ashok. We also have Mr. Puneet Renjhen. He is the Executive Vice President of Partnerships and Alliance and a member of Group Executive Board at Mahindra Assistant, with almost 20 years in investment banking, primarily with Avendus Capital, Citi, and Standard Chartered. Puneet has advised both global and Indian corporations on financing advisory and capital market transactions of greater than $25 billion. Thank you for coming, Puneet. So we may now begin. So Ashok, can you please make a case of why India is a generational business opportunity? And in like a round of 3 minutes, but how do you think it's a generational business opportunity in India?
Give me 30 seconds more only, ladies and gentlemen, because I first want to thank Stuart for having invited me. He called me, I said, absolutely yes, because, you know, as a young kid growing up in the city of Kanpur in a school called Schillinghouse, the only thing you heard about was Cambridge and Oxford. I've done my bit in Oxford. This is my turn to do my bit in Cambridge. So thank you, Stuart, for inviting me.
You saved the best for last.
Oh, you know what? It's also a great coincidence, ladies and gentlemen, that one of the persons interviewing me today, 30 years ago on June the 1st, 1994, was interviewed by me for a job at Arthur Andersen. Now, that tells you how old I am. But it also tells you that it's a wonderful place to come and reconnect. So thank you very much for the second opportunity, Marvin. So why India? You know, in July last year, Daiwa Securities invested in Ambit. While at the press interview, the one thing Nakata-san, the CEO of Daiwa said, and it remains embedded in me, is to say, I'm investing in Ambit and India, not for the next 10 years, not for the next 25 years, but for the next 100 years. And in many ways, that sums up the philosophy with which you need to invest in India. Patience and persistence are the two big factors, I would say. And having been in business for so many years, I will tell you that some things have changed and some have not changed. What has changed, of course, is that India is far more receiving. The old mindset of East India Company is gone, destroyed. Good news. Reforms are here, and it doesn't matter which government and what coalition, reforms will happen. We will move forward with the reform process. I don't need to talk about the consumption and the population and the growth of the Indian economy. That's very, very obvious. But I would say that there are 2 or 3 important changes. Tax terrorism, which was one of the big factors that caused foreign investors to pause in India, is a matter of the past. I'm not saying it's eliminated, but I'm saying it's significantly reduced. And we now have a regime called faceless, which effectively means that you don't need to go see the tax inspector, which is great. I would say the other thing that has changed is a real amendment to archaic regulations in India, including labor law. People think that labor law in India is difficult. I promise you it's much easier than many European countries. And therefore, if anybody worries about setting up manufacturing business in India because you're worried about labor and challenges of dealing with labor, I think that's a matter of history for sure. The Indian legislation is now quite forthcoming and quite positively oriented towards allowing people to deal with labor in the manner they think deemed fit. And the last issue I would say is if you ask financial sponsors, and in particular if you were to, 30 years ago I did the first deal for Warburg in India. That was 1995. And there was a great concern at that point of time that India was a great destination to receive capital. The great concern was, can we actually repatriate our money out? And I would argue that in the last 5 years, the robustness of the Indian capital markets has demonstrated that there is absolutely no danger and there is absolutely no concern about your ability to be able to remit money out of India. There is adequate liquidity in the market, there is enough opportunity to monetize, and the tax legislation being what it is, I would argue that all these favor India as a wonderful destination, other than, of course, the growing economy and stable politics.
Thank you so much for such a succinct discussion. Puneet, would you like to explain how you think India is a generational business opportunity that we have here?
No, thank you, Sonia. And I think it's always very difficult to follow Ashok, especially when you've grown up idolizing him. And Ashok, that's not a reflection again on your age, sorry. But it's just, I am nervous sitting next to you, but it's a pleasure. And for me, coming back to UK is, keep coming back, but it's very nostalgic. I kind of started my career here. I was sharing with some people in Citibank here. And one of the largest deals which I've done of my career, which now I sheepishly talk about because I work for the competitor, was advising Tata Motors to acquire Jaguar Land Rover. And the reason I bring that up is there is a context. The day the deal got announced in November 2007, if I'm not wrong, sorry, 2008. My dad was there and he kind of took a cutting of the Daily Mail newspaper and he still has it with him. And the reason was it just said reverse colonialism, right? I think that now if you put that into context, that's when the growth story of India really started. And we did have some hiccups and we'll talk about it more, but I think now we are kind of regrouping ourselves and getting back into firm footing where we are really solidifying the core in India and kind of taking it forward. And I'll give you a few statistics since my job does involve a lot of numbers. We are 3.7 trillion today. We're going to be around 7 trillion in 2030. The total amount of GDP we are going to add in India in the next 7 years is combined of what the European Union will add. That is what the opportunity in India is, right? It's a kind of a once-in-a-century opportunity where a country is kind of going to move from the 5th largest economy to the 3rd largest economy. So I'm just giving you these high-level stats, and we'll talk in more details in terms of what are the kind of opportunities all of these what will happen behind all of these numbers to come true. A lot of the stuff, like Ashok mentioned, about reforms, about growth, etc., will happen. I'll end by saying that, at least from our perspective in Mahindra Group, we believe there are around kind of 10 sectors which will kind of lead the growth from 3.7 to 7 and then hopefully to 30 trillion by the Prime Minister has kind of come up with that agenda for Viksit Bharat. We as Mahindra Group are present in 7 of them. Right? And we are very, very bullish. It actually becomes very, very difficult for us to choose from a capital allocation perspective on which sector to not invest in. And because every CEO every day comes up with very, very big plans for growth because they're all feeling very buoyant. You look at the automotive growth, it's growing at close to 10% CAGR. You look at tractor growth, that's going to, again, growing at less than 5% CAGR. You look at real estate, you look at logistics, look at multiple sectors we are talking about. I think a lot of them are kind of going to create a lot of opportunities for the India story. I'm happy to delve into more detail.
Thank you so much, Puneet.
Just a quick follow-up question to that. I'll start with you, Puneet. So you talked about the opportunity being so large and diverse. How do you at the Mahindra Group make those decisions and choices, whether it's capital allocation, but also based on capabilities? So give us a little bit more flavor of your thinking and framework that you're using, and which sectors you've come to focus on.
Sure. So maybe I'll start in the reverse order. So from a sector's perspective, what we've done is we've kind of segmented our sectors into 3 buckets, what we call core businesses. The core businesses are our auto and farm business, where we are market leaders in India. Actually, in tractors, we are the market leader in the world by volumes. And the idea there is to strengthen the core further, where we basically just keep capitalizing on the market leadership and not lose that position. Then we have 2 other large businesses, which is financial services and IT services, where we believe that the opportunity is huge from a scale perspective. We are amongst the top players, but not the largest players. The idea is to kind of get to the largest player. And then what we have is what we call growth gems, which is the most interesting part. These are growth gems where we've told them, you need to grow 5x in 3 to 5 years. Now, clearly, India is not growing at 5x in 3 to 5 years, which means these businesses, we see there is a market opportunity to either kind of gain market share, expand globally, et cetera, through partnerships, and kind of grow 5x. And those, I mean, I won't talk about all of them because it's kind of, we are listed and it's all on the website, but let's say logistics, real estate, financial services, I spoke about, which is more housing finance and that, hotels, renewables, last mile mobility, which is our electric three-wheeler business, et cetera. So these are the sectors we are focusing on, right? Coming back to your question first in terms of how do we decide, I think we've already done that journey. So we had 3 phases when our group CEO took over, Anish, and some of you know him. In FY 21 to 24, the focus was on capital allocation, and we actually exited 15 businesses. So we had a lot of businesses which weren't making sense, and we've exited all of those 15 businesses. And the clear focus is you got to be in the number 1, 2, 3 player in your sector, which we believe these 11 businesses now have. The second is you need to have a very clear path to 18% ROE. Right? Now, each individual business might not get to an 18% ROE, but on a blended basis, you need to be close to that so that as a group, we are delivering 18% ROE to our shareholders because our parent company is listed. It's very clear that that's how capital gets allocated. Every project is looked at from an ROE perspective.
Thank you so much. And on that ROE context that we would like to take, how are these higher valuations in India contexting around where we're thinking about what should the foreign firms look for in making acquisitions and strategic investments in India? So what are those considerations that we have?
I don't think we are overvalued, so I'll leave that question to Ashok.
Yeah, but you know, it's interesting. All roads lead to Anderson's. The CEO of Mahindra and Mahindra is also an alumni of Arthur Anderson. So it's interesting. I heard this question earlier in context of to Ashish when somebody asked, is in the Indian market overvalued? And I know he said that the growth in India justifies the valuation, and I would tend to agree with him, that the growth in India at this point of time, not just the growth in India, but I would argue that the relative growth in India. It's absolute growth, but absolute growth at a time when the world is devoid of growth anywhere else makes India look spectacularly nice, even better than what it actually is. And that's what is kind of justifying the growth. I would say this, that there is a bit of a mismatch in supply and demand in the Indian market, in the sense that good and clean companies, and we define good and clean on 3 simple parameters: good governance, good accounting, good capital allocation. If I was to use the good and clean framework, which is the basis on which Ambit identifies all companies, either for research or for its own fund management businesses, I would argue that you will actually come to a relatively small list out of the 1,000-odd listed companies in India. And the problem is that because these companies are few in nature, certainly the passive funds, which are becoming larger and larger in quantum, are naturally converging to these. So the demand-supply mismatch in some ways is also responsible for why you have some stocks which are disproportionately higher in valuation. How do people make decisions? Again, I would divide them into 2 or 3 different parts. The strategics actually don't care about it, because the strategics come in with a very long-term perspective, a 10-year perspective, a 15-year perspective. I gave you the example of Daiwa earlier. But you know, take Siemens, for example. I mean, we did the first Siemens has been in India for 100 years, and we did their first ever acquisition in India 2 years ago, right? It was not cheap, but they acquired it because strategically they thought that this was going to be a wonderful investment. We did a sale of a housing finance company to TPG only a year ago. At that time, it looked expensive. They bought it at 3.4 times the book. And you know, today, the same stock would be valued at 4.5 times the book, because the housing finance, affordable housing finance companies have really moved up the curve a few notches. So I would say that valuations in Indian context, particularly looking at the growth on one side and the longevity on the other side, is not necessarily the most important factor. I think what more and more companies are looking at are strategic fits. What more and more companies, particularly financial sponsors who are now a very big driver of what's happening in India, what they are looking at is how clean is the promoter? Is it in the space in which I think I'll be able to get an exit at the appropriate time? And that becomes a very important factor. Historical evidence shows to us that over a 5-year period, honestly, entry price becomes relatively less relevant. What is really more important is how you grow that business from the time you acquired it, and how you leverage the current opportunity, and eventually how you exited to who you exited eventually. So I would say valuations are not playing a really big role at this point of time.
Ashok, just a follow-up question for you. Linked to valuations, with companies in India having so much currency in stock markets, do you think we'll see cross-border acquisitions? So Indian companies going global via acquisitions, or even Indian companies taking their brand abroad, beginning to resurface? And what are some of the issues that would come in the way of that?
In the many years, Marvin, that I have been doing business in my industry, I have learned one thing, that India never gets it right the first time around. Because the first time around, India, and more importantly, Indian promoters, they are the big decision makers, are driven by vanity and competitiveness than by economics. So the first round of global acquisitions that happened out of India, and you can take any company, Wokhard made an acquisition, United Spirits made an acquisition, Birla made an acquisition, Tata's is perhaps an exception, though even there, they made two acquisitions. They made a Chorus acquisition and they made, and some of these companies are really very well governed and very well managed companies. So I won't necessarily put the vanity factor in their case, but I would argue that there would be at least 25 other examples where there was no business and economic rationale to be making those acquisitions. And remember, these acquisitions were largely funded by debt. And what people don't realize is that debt compounds so fast that if you have 1 or 2 years of a slow-growing economy, you're done, right? So the first round of acquisitions made by Indian companies globally, I would say, was a failure. Perhaps a few exceptions, Jaguar Land Rover being the best example of the exception. This time around, there are two different things that have happened. One, of course, the size of Indian companies in this 15-year period has grown dramatically, right? Think about it. 20 years ago, you rarely had a company that had a $10 billion market capitalization. And today, if you don't have a $100 billion market capitalization, you are seen as small. So the perspective has changed in this period, number one. Number two, obviously, there is currency, whether you do fundraising, raise liquidity, and then buy it, or you just use your stock. So Indian currency is now valued and valuable. And I would argue that Indian companies have matured, Indian promoters have matured, and are now looking at very strong synergies and economic rationale as the basis for which an acquisition should be made. I would argue, and perhaps Puneet is a better person to answer this question, but I would argue that you would see a new spate of acquisitions, strategically well identified, well defined, from Indian companies, particularly larger Indian companies, for their global peers. Just the last point, it is also probably the right time because globally, as you see, economies are rather weak. And this is the time when valuations across the globe, particularly in Europe, are relatively cheap compared to India. So one currency is valuable, the other currency is relatively cheap, perhaps makes for a very good and strong case for strategic acquisitions. But Puneet, over to you on this one.
Well, thanks, Ashok.
Puneet, before you go, if you could also touch about the cultural aspects and the partnership with making acquisitions would be good.
No, I was actually going to talk about that only. I think 2-3 things have changed. I think Ashok touched upon a very important point that a lot of the earlier acquisitions, and we in Mahindra Group also made some acquisitions, and I'm very happy to candidly admit some of them, actually majority of them did not do well, right? We acquired Peugeot two-wheelers in France. That's something which I kind of cleaned up 2 years back. We acquired SsangYong in Korea, which was a very large acquisition. Those didn't do well. Some of our farm acquisitions did very well. And if you ask me, there were 2 reasons why what we've learned, and I'm sure it's kind of the playbook for most other conglomerates or corporates as well. I think the first is, do you have a right to win? Just because you make cars in India does not mean you can go and sell two-wheelers in France or make cars in Korea, right? Very, very different consumers, very, very different industrial laws, very, very different and difficult labor laws. Ashok touched upon that. I can tell you it was very, very difficult, right? So I think that is one, that you really need to identify that do you have a right to win where you can actually really go and start selling in that market and really start managing operations. That kind of comes down to the culture as well. A lot of times the Indian companies kind of put their managers there who really didn't understand those businesses, right? And they were basically given a free hand with not that much of tightening of screws on capital allocation. I think we need to probably be more conscious of that this time. The last thing I'll touch upon that is, I feel that earlier I had looked at it as from an outsider, as an advisor, and today I looked at it as an insider and being on the group board. I think Indian boards have evolved a lot. The role the independent directors now play is very, very strong, right? They question everything. Why are you going and doing something outside? Is the opportunity not here? How will you manage it? Who is the CEO? Earlier acquisitions were made, and then the CEO used to be decided, and the CEO's view on the business plan used to be very different than what you acquired it for. Today, we actually look at it, the blueprint is first we identify the management team if we're going to make an acquisition, and we make sure the CEO and the CFO are a part of the diligence process and they're going to sign up to it. And we kind of monitor that going forward. So a lot of that also aspects, and the board really, really kind of pressurizes us to do that. I think those things, if they are put in place as the playbook, to Ashok's point, acquisitions will happen. There will probably be a little fewer than they were in the pre-Lehman era, but I think they will be more successful this time. And they will be larger, not too many.
I like the right to win phrase. It's a good starting kind of filter to look at. Before we move on to the next section, which is all about challenges to the India story, I think one thing would be great from your point of view, would be throw some light on the other India, the rural India, and what's the opportunity for rural India? Will there be a catch-up with India 1, India 2, India 3? What's your insights for us?
Clearly, there is an opportunity. I think the last few years has not been good in terms of compared relatively to the urban India. So today when we see cars, they are actually selling off the shelves. You don't really need to, you just need to launch a product and launch a good product and it sells. Rural India, you need to continue to push, build the relationship. I think again, there is not a single playbook which works for across India. India is different and Bharat is different. I think in rural India, you need to really understand the customer, build a relationship, right? And then you can kind of go and start selling your products. As far as the growth is concerned, I think the growth is, at least what we are seeing, there are some green shoots. It's kind of turning around. Hopefully the monsoon will be good. The government looks like putting a renewed thrust on the rural economy, and that will hopefully lend more spending power there. And it'll come. I mean, look at it. At the end of the day, if you see the digital penetration, the mobile penetration is already very high, right? So they are kind of used to the new economy. Maybe they didn't have that much of disposable income. I think the second is that as and more education kind of starts penetrating in the rural sector, as they get more aware about what the opportunities are, more people kind of come into the working force. Again, that will kind of throw up more growth opportunities.
Just one point to Puneet's, just extending to the point Puneet made, is on the lending side. And that's something we shouldn't ignore. On the lending side, rural India today offers a really large opportunity. Both the government policy making, the government initiative, as well as the opportunity augurs very well for the future, because through the process of Jan Dhan, the bank accounts that government opened, the digitization of the whole process, you can actually see how the common man in the village is actually moving out from the informal to the formal credit system right now. So NBFCs, and we have large NBFC focusing on tier 3, tier 4 cities. Mahindra's have one, focusing on tier 3, tier 4 cities. That opportunity is a very, very large opportunity. And I would believe that as more and more lending businesses bring more and more potential customers into the formal zone, you will see an uplift in consumption generally.
Thank you so much on the optimistic point of view, but now we come to the realistic point of view of this business in India. So we're going to talk about the challenges that we see. So more open to both, like what are the biggest challenges that we are seeing in doing businesses in India, also above the India story that we're looking at? So what are the major challenges that you're able to look through?
And some mitigation.
Yeah. Listen, I mean, if you think that this India is very different from the India where you invested 20 years ago, it is and it is not. I think anybody who takes a short-term perspective to India is making a mistake. It was true 10 years ago, 15 years ago, it is true today. I would say the challenges of doing business in India have to some extent been reduced because of focus on improving the environment for doing business in India. But, you know, whether it is buying land, whether it is setting up a factory, whether it is dealing with amended laws, both labor laws and corporate laws, challenges continue to prevail. Challenges continue to prevail. It's not as if these changes have completely eliminated those challenges. I'd like to believe that when you decide to invest in India, you have to take, as I said, apart from a longer term perspective, you also have to account for delays in almost everything. You have to accept that what we learned from the British continues to prevail in India even today, which is aggressive bureaucracy. It's only growing. They say there are only three things that combine the two of us: bureaucracy, cricket, and the railways. And that's true. Bureaucracy is certainly one such factor. I would also like to believe that you know, doing business in India in certain sectors, and manufacturing perhaps is one, most foreign investors tend to believe that they would like to partner with an Indian partner. I think an Indian partner plays a very important role in many ways smoothing the curve and bringing experience of how to deal with day-to-day bureaucracy, day-to-day delays, and day-to-day challenges. Yes, corruption has come down, but corruption has not been eliminated. And I'd like to believe that with the diversity that we have and the size that we have, it's virtually impossible to completely eliminate that. So one certain piece of advice that I would give is, if you are in a business which is quite intense and has a long gestation period, combining your strengths with an Indian partner is perhaps a better alternate than trying to start it purely on your own. And then in due course, you can continue to acquire larger ownership, and who knows, one day you may even be a 100% owned company.
I think from my perspective, and I'll make it a little more specific, Ashok's already covered it quite well on a macro basis, is don't listen to too much noise. Don't get over exuberant. Like Ashok mentioned, it is a long-term story. And I'll give you a few specific examples. Just before coming here, boarding the flight, we were discussing, we have a large real estate business, which does more affordable housing, and the cycle's been good. And like I said earlier, the plans keep looking better every time. But listen, the cycle will turn at some point in time. It is a cyclical business, right? It will turn. And are you kind of being over exuberant by saying, you know what, no, India is just growing and we will just continue to build houses and we will continue to kind of, absorb them? No, that won't happen, right? Because then you will commit a mistake. You'll probably take over, leverage yourself, et cetera, et cetera. So I think just having feet firmly on the ground, that focus on your core principles. If we as a group have set out an 18% ROE, we are not going to take too much leverage, etc. Just make sure you continue to follow those even in exuberant markets, right? And second is, some of you spoke about it earlier as well, in terms of why are valuations kind of running ahead of themselves. I don't think they're running ahead of themselves, but yes, they are running ahead of profitability because India Inc. in the last few years has focused on transparency and governance. Don't lose sight on that. I mean, if I just look at our group market cap has grown at a CAGR of 51% in the last 4 years. Profitability has not grown that much because all public market investors tell us, we're really loving that you guys are being very transparent of how are you looking at each business or what the metrics, etc. The moment you stop focusing on that, I think we are headed for trouble.
How are Indian businesses looking at the risk and opportunity from climate and nature and biodiversity impact? Are they, well, I'll just leave it open-ended like that.
So I'll share a statistic which I was telling you, right? I'll share with the wider audience that there was a poll which was done for a lot of listed company CEOs globally, and sustainability or lack of focus on sustainability from a CEO's perspective is 57% of Indian CEOs voted that as one of the biggest risks. Global average was 33%. So I would say a lot of Indian business CEOs are actually focused on sustainability. I think that's two parts to it, right? One is, do you have businesses which are investing for climate change? So we have, like, for example, renewables, electric vehicles, et cetera, and the other is, are you incorporating sustainable practices in other businesses as well? So, for example, we launched India's first ever zero waste residential project. What are you doing in terms of your supply chain practices on the farm side? What are you doing for sustainability on some of the other logistics, other manufacturing business? I think that is very, very critical. And I think Indian businesses are very, very conscious of that because investors are demanding it, right? We don't have yet sustainability standards. Hopefully they will come soon. But I think when we start the first slide of our investor presentation, if you go to our website, we say we want to do two things: deliver 18% ROE and be a global leader in sustainability. Because we know that that kind of gets you that extra valuation premium.
Are the supply chains, you talked about that statistic in terms of how important they think it is at the board level, but are you seeing action in making supply chains more robust? Across the board,
yes
M&M
and no.
and across the
yes
board.
and no, and I'll tell you why. No, because it's costly, right? It is looking at a long-term objective being met at the extent of probably short-term profitability. So that is why no. Yes, because like I said, global investors are expecting. So if I expect Stuart to invest in, Leapfrog to invest in one of our companies, they will have a global ESG policy, which they will expect each of every of their investee company to follow. We have BI invested in it, and I can tell you their ESG policy document was bigger than the shareholders agreement, right? And you got to follow it. And I do know some people were not very happy because they're like, listen, this is going to cost us. And we're like, listen, that's fine. We're building a business for 10 years. If you want them as an investor, you need to follow it. So I think it needs to be pushed by the external world. Otherwise, it will not happen on its own.
And I would say that external investors are playing a dominant role in influencing that, because it's clear that you get at least one, if not multiple turn on your valuation if you are ESG compliant. We've actually come out with a research report on ESG compliant and identifying how many companies are really in compliance of those rules. And those research gets very actively used by particularly passive investors.
Thank you so much for the wonderful insights. Now it's time to open the question and answers to the audience. If there's anyone, yes, maybe here.
Hello. Yes. Hi. This question is directed at Puneet. First of all, congratulations to the board on what you achieved with Anish and team at Mahindra & Mahindra. I think this has been amazing over the last 3 years. My question to you is, now 2 months back, you have set a very ambitious target in terms of what you're going to do in terms of improving return ratios and margins at Tech Mahindra and Mahindra Finance. Now, I don't want to really make the question very long, but the background is quite challenging. So I just want to have your views and bet on how really you wish to achieve the same.
Sure.
Thank you.
So both of them are listed companies, so I can't talk much in detail about UPSI information, etc. But I think what I can tell you is there are individual things which have been identified. Again, the idea is to go deep. Individual things which have been identified. For example, in financial services, I think what we needed to do is we need to diversify our book. Large part of the book is very concentrated towards a few sectors. So you need to diversify the book so that when there is a downturn in one or two sectors, it doesn't really impact the overall book quality. The second is it's an old archaic business which was built. It is slowly getting digitized, right? That will lead to significant improvements from a cost perspective. I think the third is look at new areas of growth which you are not in, but you already have the customer or profile already. So for example, if I am lending to a customer for his auto or his farm needs, obviously I understand his credit profile. Can I look at other segments like housing, consumer durables, etc. as well? So that will hopefully help improve profitability. But more important than the last thing is, going back to my earlier point about don't get exuberant because there is a lot of growth, right? The consumer wants a housing loan, the consumer wants a consumer durable loan. Very, very stringent underwriting standards. So that's hopefully a combination of all of this will lead to better margin profile in financial services. Again, see, IT services is a little different because it's kind of a very large global business. 95% revenues comes from globally, so there are challenges, global headwinds. But there again, there are some interesting things which we know we can already solve for. We've kind of already seen where we can, concentrate on a few industries where we have strong presence. Look at kind of building capabilities in AI. Look at building some product capabilities, getting more wallet share from existing customers, etc. And Mohit Joshi, who's our CEO, has kind of already laid out that plan. So hopefully, and The question you asked is very important because in both of these businesses, the focus is not chasing growth, but improving margins. Going back to my earlier point, let's not get over exuberant about growth.
Thank you so much. We just have one more. Okay. Yeah.
I'm a student at King's and I am ESG. I have a question for Mr. Ashok Wadhwa. Last week I was talking to Mr. from Fernandes and discussing how macros in the US makes much less financial sense than India. So I wanted to ask you how we could change FIIs and FDIs mindset into investing in India much more.
You know, actually, we don't need to do too much. Just make sure that we don't do too wrong from what we are doing. FIIs and FDIs, obviously, clearly different categories of investors. FDIs are truly looking from a longer-term perspective. And so long as the reform process continues, which it is, so long as there is adequate political stability, which there is continuity in that sense in the reform process, so long as we continue to demonstrate that India is very open to receiving global investment, and you know, whether it is in manufacturing, which is where you're going to probably see the maximum amount of new investment, or in real estate, where you're already seeing a significant growth. Infrastructure is the third area. I think we will continue to receive large doses of strategic investment. As far as financial investments is concerned, I mean, clearly, governance plays a very important role. And as Puneet pointed out, the fact that Indian boards are now very active, the fact that we have independent advisory firms that are very objective in their advice, and that every other institution follows that advice, I think is a very good recipe for continuing to receive large doses of capital on an ongoing basis. The last thing I would add is from a financial sponsor perspective. I always keep them separate because they are such a large investor in the Indian system right now. I would say that so long as they continue to feel comfortable that there are more than adequate opportunities for them to monetize and be able to freely repatriate their monies without any tax terrorism and without any exchange control restrictions, which is all par for the course right now, I'm not sure we need to do too much. So long as we don't disturb what we are doing right, these capital flows will continue unabated at this point of time.
Thank you so much, Puneet. And Ashish, I think we have rounded up this session. So we'll now take this class, and we would like to invite the sponsors for our memento of appreciation. Thank you so much.
Thank you both.